joining us today for a very interesting discussion on the Inflation Reduction Act and how to leverage the incentives to your company's benefit. Over the next hour and a half, we will hear from several speakers with a variety of backgrounds and expertise so that you can develop a well-rounded understanding of how the IRA will impact our climate goals, hear updates from Washington on the status of implementation, and discover how renewable energy companies can take advantage of these energy tax credits written into the bill. Should you have any questions for the experts, please feel free to post them in the chat by clicking on the icon on the bottom right of your screen. I will be monitoring this and then directing your questions to the speakers. There will be time for Q&A at the end of each module, as well as a Q&A session at the very end of the webinar for any question that was not answered or could require further clarification. I'd also like to take a second to thank everyone who contributed their time and efforts to make this webinar a success, to our experts, the team at KTS, as well as our team here at the RGB. Thank you very much. On that note, I'd like to hand it over to our Vice President here at RGB, Mirko Wutzla, and then to Sigmar Pohl, partner at Kilpatrick, Townsend, and Stockton for a few welcoming remarks.
Yeah, thank you, Larissa. Good morning, everyone. It is my pleasure to welcome you all to today's webinar on behalf of the German-American Chamber of Commerce to talk about IRA. This is a topic that is really important and dear to our hearts since it's a significant investment in clean energy and greenhouse gas reduction here in the US and can make a significant impact on mitigating climate change. And in our role as official representation for German industry, we are a platform for discussing topics with transatlantic relevance and providing our stakeholders with information on market opportunities as well as on impact and support them with market entry. So I'm looking forward to the discussion and want to thank all our partners, also my colleagues throughout the US from the other chamber offices who also cooperated with us on this event. I want to hand it over now to Sigmar, who had the idea for the webinar originally. We listened to the same podcast and then discussed the impacts over lunch, and that's how it came about. So please, Sigmar, time for you.
Yes, you're right. Thank you, Larissa. Thank you, Mirko, for the kind words. And yeah, my name is Sigmar Pohl, who those who don't know, Kilpatrick Townsend. We're a full-service firm with 17 offices and 600 attorneys, East Coast to West Coast. And I'm part of our energy team as well as part of our German practice, where we help German companies do business in the United States and help with market entry. And that in that capacity, we also have been members of the GACC for many years. But yeah, so as we all know, German companies have been at the forefront of innovation in renewable energy, clean tech, and also now climate tech. And the new Inflation Reduction Act is really the single largest investment in climate and energy in American history. So this morning or afternoon, we're trying to talk about like how we bring the two together and how we can leverage the IRA for domestic energy companies, but also for foreign, in particular German companies, and how to bring this together, how the IRA will help achieve the policy goals, the climate goals of the US government, but also how companies can actually tap into the new funds of unprecedented size. And with that, I'm excited to hear and participate in this morning's panel, and also hear from my colleagues from our government relations team on the Hill, so to speak, and then also our tax experts. And with that, thank you to the GACC for organizing this with us, and I'm looking forward to great discussions.
Great, thank you, Sigmar and Mirko. So at this time, I'd like to introduce our keynote speaker, Dr. Ryan Weiser, who's a senior scientist in the Office of Policy at the United States Department of Energy, on detail from Lawrence Berkeley National Laboratory. At the DOE, Ryan leads and conducts analysis to inform energy policy with a primary focus on the power sector. At LBNL, he helps lead a 40-person department that seeks to inform public and private decision-making within the U.S. electricity sector. I could go on and on about his impressive resume, but for the sake of time, I'll just mention that he was a lead author for 2 reports by the IPCC and has offered invited testimony to the United States Senate. I'm excited to hand it over to you, Ryan, to hear your insights on the impacts of the IRA on the power sector and on GHG emissions.
Super. Thanks, Larissa, and good morning, or I guess good afternoon, perhaps, for some of you. It's a pleasure to be here to provide some of DOE's perspectives on the Inflation Reduction Act, which I may at times call either IRA or IRA, depending on my mood in the moment. Before I begin, maybe just a little bit of background to situate some of my remarks. As Larissa noted, I am a national lab geek. I've been at Lawrence Berkeley National Lab managing a renewable energy analysis program for the last 25 years. But over the last year and a half, I've made my life considerably more complicated by holding down 2 jobs, the second of which is a detail to the Department of Energy's Office of Policy, where one of my primary responsibilities has been to provide technical assistance to Congress on the legislation that eventually became the Inflation Reduction Act. And it's really within that perch that I'll offer my remarks today. Next slide. And let me just start by doing a little bit of cheerleading. This is a huge and transformational law. And it's a huge and transformational law, not just for climate and energy, but also in pursuit of a number of other national priorities. So yes, it is clearly the most comprehensive climate and clean energy investment package in the history of the United States. It provides long-term stability to domestic clean energy producers, manufacturers, and investors, hopefully getting us off the on-again, off-again type cycle of clean energy tax incentives that have been experienced over the last couple of decades. But it's also more than energy policy. In some ways, it's also an industrial policy, for the first time offering per unit production incentives for manufacturing solar, wind, batteries, and critical materials, and a bevy of other incentives and loans to support domestic supply chains. It leans into the support of high quality jobs in the clean energy industry, with many of the tax incentives designed with a 5x multiplier for meeting prevailing wage and apprenticeship requirements. It focuses more on carrots than sticks, and there's pros and cons to both carrots and sticks in the energy and climate world. But one of the advantages of a carrot-oriented approach is that it will help drive energy bills down by offering consumers incentives for clean vehicles, for home energy equipment, and more. It also is specifically designed to benefit low and middle income consumers, historically underserved communities, and those communities that might be most negatively impacted by the clean energy transition absent policy intervention. And it does through consumer incentives that are sometimes targeted towards those specific communities, a national green bank, and direct investments in both energy communities and disadvantaged communities. And then finally, as has been widely reported, the law holds promise, of course, in reducing US greenhouse gas emissions, with the Department of Energy's own analysis illustrated on the simple figure on this slide, showing, as other studies have also shown, that the legislation could potentially reduce US greenhouse gas emissions by 40% by 2030 relative to 2005 levels. Next slide. So this next slide goes into a little bit more depth on the DOE analysis. That analysis was released a couple of months ago and represents the first federal calculation of the potential greenhouse gas savings of the Inflation Reduction Act in combination with the Bipartisan Infrastructure Law, or bill. And that analysis finds emission savings of around 1,000 million metric tons by the year 2030, helping put the nation at least within striking distance of meeting our commitments under the Paris Accord. Our analysis also confirmed what a number of other studies have also shown in terms of the sectoral breakdown. The greatest near-term reductions coming from the power sector, but as well important near and long-term reductions also coming from industry, buildings, and transportation. Next slide. So let's focus a little bit on the power sector, because it is, in fact, as I just noted, the largest near-term sector in terms of greenhouse gas reductions, but it's also the sector that I know the most about. So let's focus a little bit on the provisions here, though I will note that some of the subsequent presentations will go into more depth than the surface level overview that I will offer in this and the next couple of slides. So perhaps most importantly here, IRA contains extensions and expansions of the production and investment tax credits for clean electricity, but it does so with some very important changes. First, the extensions will only phase out once power sector emissions hit 25% of 2022 levels. Now, if you do the math, and if you also consider the start construction type guidance that Treasury and IRS have issued in the past, what that means practically is that projects that are built that go into operation in the late 2030s or even into the 2040s may have full access to these tax incentives. As well, for the first time, the incentives will apply to all zero carbon technologies, notably inclusive of standalone storage, and in 2025 and beyond, new nuclear as well. Projects will now have a choice between the PTC and the ITC, presumably selecting that which provides the greatest federal cost share, and also presumably leading a large number of our utility scale solar deployments to choose the more lucrative PTC over the historical use of the ITC. Now, there are some conditions here. To receive the full value tax credits, certain labor and apprenticeship standards will need to be met. But on the other hand, there are a number of bonuses that enable projects to potentially get much higher tax incentives if they're located in energy communities, if they meet domestic content thresholds, or in certain circumstances, if they benefit or are located in low-income communities. And importantly, those bonuses are additive, meaning that 40, 50, 60, or even 70% tax credits might be available in certain circumstances. Now, it's also important to note that that's not all. The ITC for residential solar and now standalone storage has been extended into the 2030s. Existing nuclear plants will earn the production tax credit, helping maintain plants that have otherwise been at some risk of retirement. We have a new PTC for hydrogen linked to life cycle emissions, and the tax credits for both CCS and direct air capture have been extended and expanded as well. We'll also hear in more depth a little later that for the first time, some of these tax credits will be directly available as cash payments to nonprofit entities, co-ops, and public utilities, while other entities will have the ability to transfer tax credits to others, potentially opening up some new avenues for project finance. Now, if that wasn't enough, in addition to the tax credits, IRA contains a number of other grant and loan programs that are noted here on the right. This is just a small subset of the full suite of those programs, but you can see significant transmission funding available through the Department of Energy, significant funds from the USDA to support rural co-ops in their transition to clean energy, $250 billion of loan authority for the Loan Programs Office at DOE to help support the repurposing of existing energy infrastructure for clean energy. And as I also noted earlier, $27 billion for the EPA's Greenhouse Gas Reduction Fund. Next slide. So in addition to spurring the deployment of clean energy, as I also noted earlier, IRA also has important components of industrial policy. And more specifically, in addition to sort of conditioning some of the deployment-oriented tax credits and meeting domestic content thresholds, I mentioned that earlier. Again, it will be described in more depth in some of the presentations to follow. For the first time, IRA provides pretty lucrative, albeit time-limited incentives for the domestic manufacturing of wind equipment, solar equipment, batteries, and critical materials. And as well as noted on this slide, though I will not go into depth here, it also contains a number of other grant programs and loan programs, all intended to support domestic supply chains for clean energy equipment. Next slide. And there is more still. Again, I won't go through all of this at any level of depth, but importantly, tax incentives not just for clean power and supply chains, but also for clean vehicles, for clean fuels, for buildings, and then a bevy of rebate, grant, and other programs in significant measure trying to target lower income and disadvantaged communities. Next slide. So in effect, if we look across all of the provisions in the Inflation Reduction Act, the act simply makes clean energy cheaper, and in more cases, the obvious choice. Home efficiency and electrification will now pencil out financially for a greater number of households. EV adoption will increase. Fuel purchasers will have access to cheaper and cleaner fuels. Electric utilities will need to kind of recalibrate their plans for energy supply, given the altered structure of the incentives that are available. Corporations with sustainability goals will be able to perhaps strengthen those goals, given the incentives available. And finally, and maybe most importantly, state and local policymakers, as well as federal policymakers, now have a new set of tools in their toolbox to potentially raise their level of ambition in achieving clean energy and climate goals. I think it's also important to recognize that in combination with the bipartisan infrastructure law and the CHIPS Act, the Inflation Reduction Act targets not only all of the energy sectors, but really all stages of the energy innovation ecosystem. And what that does ultimately is it holds the prospect not only for impacting near-term clean energy deployment and reducing greenhouse gas emissions through 2030, but also in helping to develop some of the technologies that will be needed to achieve some of our longer-term goals beyond that 2030 timeframe. And then finally, as I noted at the beginning and really throughout, IRA is much more than just national energy and climate policy. It intends to target any number of other national and local objectives as well. Next slide. So I want to end, though, by emphasizing that the Inflation Reduction Act is not self-executing. The job is not done. There is plenty to do to implement the Inflation Reduction Act. There are plenty of deployment barriers that still bedevil clean energy development in this country, and plenty to do by state and local governments and the private sector to recalibrate on some of the opportunities that lie ahead. After all, on the one hand, the potential for a true power sector transformation has never been more real. This slide, as an example, illustrates the results of several external analyses of the potential impact of the IRA on the power sector. And those assessments show a range of possible impacts, but also illustrate the potential for clean electricity shares. That's wind, solar, other forms of renewable energy, nuclear and CCS. Those clean electricity sources could make up as much as 70 or 80% of the power supply mix in 2030, up from just 40% today, with much of that growth dominated by wind and solar, which could see more than a doubling of annual deployment rates to about 75 gigawatts per year. Next slide. But of course, those results are not predetermined. Bloomberg New Energy Finance, for example, has pointed to any number of bottlenecks for both wind and solar deployment, which may yield a gap between that which is economically potential to deploy and that which Bloomberg or might otherwise be realized in the real world. There could be a difference between modeling outcomes and real world outcomes, to put it simply. And that gap might be due to constrained supply chains, transmission and construction limitations, and siting and permitting challenges as well. And that work from BNEF just again underscores the key point that there is more work to be done now that IRA is law. Next slide. So it is time to get to work, certainly not to rest on our laurels. And in that respect, I'll just end by emphasizing again the critical role of the tax incentives embedded in IRA, and also the importance for all of you to share your voice and your perspectives on what guidelines the US Department of Treasury should develop in implementing these important provisions. And to that end, I'll simply note that Treasury has so far released 6 notices requesting comment on a subset of the tax provisions. Those are listed on the slide here. and comments ideally would be submitted by November 4th. And I think we can also anticipate that there will be some additional opportunities for comment on many of the other tax provisions that are not listed here in the weeks and months ahead. And with that, I will close it out here and open it up for a few questions. Thanks.
Right, great, Ryan. Thank you so much. So if anyone has any questions, pop them in the chat. I'll give you a few minute or so to do so. Okay. So it doesn't look like there are any now, but we do have a session at the very end of the webinar for the questions, so we can redirect that back onto Ryan. Oh, here we go. Here's one. What are ways we can reach out to the DOE working on grants or loans and application comment guidelines for companies?
Yeah, great question. So let me point out first and foremost that DOE has a long history of issuing requests for information in advance of any funding opportunity announcements. And so what one can certainly anticipate in the months ahead, that DOE will be requesting comment through the formal RFI process. That certainly would be the case for the vast majority of the provisions here. Beyond that, feel free to reach out to me. I can certainly connect you with some of the folks who will be leading some of those initial provisions. Some of that is still getting worked out within DOE. But again, there will be formal opportunities to provide comment, but of course, there's always opportunities to reach out one-to-one with DOE staff as well.
Great. And Ryan, there's one more question here. What would a change in control of Congress in these midterms portend for the IRA and its benefits?
Well, look, the IRA is law. DOE and Treasury, EPA, USDA, we all have to operate under existing statute and implement the provisions as in statute. Will there be opportunities in the future to make adjustments to that underlying statute? Of course, that's at Congress's discretion for sure. But in the meantime, it's full steam ahead. DOE has a lot of work to do. Treasury has an awful lot of work to do. EPA has plenty of work to do. USDA, Interior, et cetera. So we're just going to keep implementing the statute as it stands.
Righty. And it looks like, oh, two more came in. I think we just have time for one more. Is it possible that the IRA will pay for itself and will not add to the deficit?
Well, I'll just point out that the climate and energy provisions in the Inflation Reduction Act were not all of the provisions in the Inflation Reduction Act. Maybe it would not have been called the Inflation Reduction Act if it was just the energy provisions. There are a variety of other provisions that address healthcare, the alternative minimum tax on the corporate side, and others. And on that, the Inflation Reduction Act has been calculated by the Congressional Budget Office to reduce the deficit as a collective. So I think it's important to recognize again that the IRA is more than just the energy and climate package. That's the package that I care the most about because that's what I work on. But there's plenty of other stuff in the Inflation Reduction Act as well.
Wonderful. Okay, thanks again, Ryan, for your insightful keynote on the provisions for that and as well as your enthusiasm for this legislation. So now I'd like to introduce two representatives from Kilpatrick, Townsend, and Stockton, partner Lynn Fowler and associate Robert Daly, who will specifically expound on the tax credits, discussing new concepts and pricing structures within the IRA, as well as the provisions for alternative clean technologies.
Thank you, Larissa. So, Alex, if we go to the next slide, I'll just start with an overview of what we want to cover in the next block of time. Larissa mentioned, and I'll start out this part of the presentation talking about some of the new concepts really in the development in the history of the federal income tax in this country that are in the Inflation Reduction Act. And then I'll turn it over to Rob, who's going to talk about the specific credits as they apply to different parts of the technology and get into the meat of the credits themselves. But I think it's important before you get into the credits to understand some of these new mechanisms that implement some of the other policies that Ryan mentioned, and we'll tie those specific requirements to get additional credits with those policies. Okay, so yes, please, next slide. All right, so the first two concepts I want to talk about are monetization concepts. Historically, with respect to any of the energy credits, whether it was the investment tax credit or production tax credit, just like almost all credits in the U.S. in the federal system, the value of the credit was the ability to reduce an existing tax liability. So if you were producing renewable energy and earn the credit, the value of the credit to the producer would be as a reduction of your tax liability going forward. And what Congress has found is that depending on who the actual producer of that energy is, it could be a municipal utility, right, that is not generally subject to tax. It could be a tax-exempt organization, a cooperative, or some other type of entity that generally wasn't subject to tax. And for those types of producers, the incentive really wasn't there directly because you couldn't turn that credit. There was no tax liability to reduce. And so what historically the market has done is to create a number of structures to provide equity investment into the project in return for an ability for the investor, who is more likely to be able to use those credits, to become the owner, in effect, either directly or indirectly, and be entitled to those credits. There are inefficiencies in that type of structure. There are certainly costs involved and the like. So one of the new things that are in this particular bill that I think is important for people to know there are these two new monetization strategies that are at least in one case, I think, brand new to the Internal Revenue Code. The first concept is what's known as direct pay. Direct pay basically says that any credit earned that is subject to this direct pay election is treated as a payment of tax. So instead of it only being available to reduce the amount of an existing tax liability, it's like you wrote a check to the government, like your estimated payment, and when you file your tax return, you would include not only the actual payments you made during the year, but also these credits for which you've made this direct pay election. And if all those amounts exceed your tax liability, instead of those amounts being carried forward to a future year, which would be the historic rule, you can actually get a refund check from the government. So just taking a simple, unrealistic answer, if you earned $100 of credit and had no tax liability and made no payments, you would get a $100 refund check from the government when you filed your tax return for that year. So that is an incredibly efficient way to receive cash funding from earning the credits, right? You don't have to find an equity investor. You don't have to go through this. You don't have to go through any structure and the transaction costs with that. It's just a matter of you earn the credit in year one. When you file the tax return for that year, you will get a refund check back in due course. So this is an incredibly valuable tool for taxpayers who are eligible for it. And to be eligible for it, you have to actually make an election during the taxable year in which the facility is placed in service. And only certain types of taxpayers, for the most part, are eligible for this. The term that's used in the statute is an applicable entity. Applicable entities are generally tax-exempt taxpayers, like charitable organizations, 501c3, what we talk about as 501c3 organizations, but also state and local governments are tax-exempt and therefore applicable entities. Tribal governments are also applicable entities and can make this election. Cooperatives also, I think, would be eligible as an applicable entity. If you are a taxable entity, generally the direct pay election is not available with certain exceptions. The hydrogen production credit is available for the direct pay election, as well as the Section 45Q sequestration credit and the advanced manufacturing Section 45X credit. taxable entities can actually make the direct pay election for the first 5 years of the project. So if you earn those credits, say in 2023 or 2024, and you make the direct pay election for the first 5 years of the project, any credits you earn, any investment tax credit or production tax credits that you earn are eligible for this direct pay. So it is valuable for those particular credits for all taxpayers, but it's also a very lucrative tool for tax exempt for the entire range of credits that we'll be talking about today. So that is the first step. So if you're eligible, either because you're earning one of these 3 types of credits and you're taxable, or you're a tax exempt entity, government, or your customers are government, I mean, this is valuable to them, then this direct pay election actually is a very efficient tool to take into account. All right, next slide, Alex. We'll talk about what happens if you can't use direct pay. Direct pay is not the only new monetization tool. In fact, there is a new concept. Like I said, this is something that we have never seen in the federal tax law. We've seen this at the state level. Certain state credits have this type of ability to transfer, but this is a first in the federal tax law, and that is what's known as transferability of a credit. Basically, a lot of people think tax equity structures, tax lease structures, et cetera, are a way to transfer the credit to an equity investor. This is a more direct route to that very same result. Transferability simply means that you can assign the right to take the credit from the entity that actually earns the credit, enters into a qualified energy facility, or places it in service, to another taxpayer who can use the credit in that particular year. And so if you comply with this new rule, you as the taxpayer who earned the credit can transfer the right to use the credit to somebody else and receive cash up front. Couple requirements at the front end is that the transfer must be cash for cash, and the transfer must be to an unrelated taxpayer. So you can't, you really have to enter into an assignment agreement that says, I have earned X dollars of credits, you will pay me in cash for those credits, and I will assign the right to use those credits to you. What else goes into that assignment agreement is to be worked out. I mean, there's still some open issues that I'll mention here at the end, but that is the basic concept. So creating a partnership or creating a type of lease structure to do that, you don't need to do that anymore with respect to the credits. This is, I think, we anticipate this to be a much more efficient way to get equity investment dollars up front for credits to be earned. So to be able to take this credit or to transfer the credit, you have to be an eligible taxpayer, basically meaning you didn't use the direct pay. And so you enter into this assignment agreement. The cash received by the entity earning the credit is not taxable income. It's just capital. So you don't have to take a haircut for the cash received, treated as income. It's just tax-free cash being paid to the earner of the credit. The purchaser of the credit can't deduct the cost of the credit by the same token. The benefit that they're getting for their cash is to actually reduce their tax liability when they claim the credit on their tax return. An important feature that kind of came up late in the legislative process is these credits can also, that are transferred, the buyer of the credits can actually offset up to 75% of an alternative minimum tax liability. I won't go too far into this, but one of the things Ryan mentioned is the Inflation Reduction Act is much bigger than the energy policies we're talking about today and the energy incentives we're talking about today. One of the tax increases used to offset the cost of these incentives is a new 15% alternative minimum tax that is that also ties into our commitments under the OECD to produce a minimum tax on global income. It's far beyond the scope of this particular, but there is a new 15% corporate alternative minimum tax on global income, and these purchase credits can offset up to 75% of that AMT. Couple of things about transferability that you ought to note that aren't on the slide. If you're transferring investment tax credits, the investment tax credit rules are subject to a recapture if you place in service an energy facility, and during the 5 years after you place in service it, you either transfer it ceases to be an energy facility, or certain other events happen, the credit is subject to a step down recapture. 20% per year is subject to recapture, meaning if you claimed $100 of credit and there's a recapture event in after year 4, you have to basically pay additional tax of $20 equal to that 20% of the credit that would be recaptured in year 5. One of the issues not addressed in the transferability rules is if there's a recapture event during that 5-year period, who bears that cost? Is that something that the earner of the credit would then have to pay directly, or would it be the transferee who actually claimed the credit? Would they have to pay it? If it's the latter, obviously, or maybe not so obviously, it would seem to me that a lot of these provisions would, a lot of the assignment agreement would address some sort of indemnification obligation on the seller of the credit to indemnify the buyer if they undertook some activity that would cause a recapture event. So that remains to be seen. There are a lot of open issues and a lot of these rules that we believe that the regulations, when they come out, will address. We would hope that in the context of transferability, who's liable for recapture is would be one of the issues addressed. The second thing about transferability is that it only applies to the credit, right? A lot of the tax equity structures, the benefits are not only the credits that are being earned in the project, but also depreciation deductions. So if the economics of the deal are to provide tax equity for the depreciation piece, you're still going to have to do some of these traditional tax equity structures to be able to have an investor claim the depreciation deduction. The transferability only applies to the credit itself. So the question, and when we talk to clients about this, the question is like, what does this mean in terms? How's the market going to shake out, right? If I earn $100 of credit, what can I sell that credit for? Again, this is a brand new concept to federal tax law, but we do have some data points from state tax law. And I'll just speak from my experience. I live and practice in Atlanta, and in Georgia, we have fairly lucrative entertainment tax credits and film production tax credits that have been transferable since day one. And so there is a market that has developed. You have a number of brokers who are basically putting together buyers and sellers of credits. It's a fairly retail market. So the buyers here in many cases are individual, presumably high income earning individuals who are looking to reduce their tax liability. And our experience seeing that market is that the credits are selling on the market for about 85 to 90 cents on the dollar, depending on the credit, depending on demand. There is a ready demand for these credits. Right now, in my experience, there are more buyers of credits than there are sellers of credits, but that the discount basically is reflective of a couple of things. One is probably the broker's profit, but also there are some risk and a return of capital, right? A return on capital. So whether the federal market is more or less efficient than this, because I think they're going to be, it's going to be probably much more of a corporate market for buyers rather than individuals. Remains to be seen, but I think using the experience we have at the state level is probably a good starting point for trying to figure out what you can get out of a credit. Okay, next slide, please, Alex. So I'm gonna touch on the next two things pretty quickly because I don't want to shortchange Rob. Ryan mentioned that again that the IRA is much more than an energy tax bill. It is also supportive of labor and good jobs in the U.S. There's a new rate structure for many of these credits that basically implement those two policies, and that is there is a in all of these in most of these credits there is a two-tiered credit structure. There's a base amount and a bonus amount that is 5 times the base amount. So if you place the project into service that otherwise qualifies, you automatically get the base amount. And let's just use the ITC as an example. Under Section 48, the base amount is 6%. But if you meet these prevailing wage and apprenticeship requirements, that base rate goes up to 30%. Obviously, a huge difference in value to implement these additional to further these additional policy goals. So what are the prevailing wage apprenticeship requirements? The prevailing wage requirement is that all laborers and mechanics employed by contractors or subcontractors must be paid no less than prevailing wage in that locality. Locality meaning the location of the facility. And that applies to wages during the construction of the project and also in the 5-year period beginning once the project is placed in service for labor used for alteration or repair of the project. So that is the base requirement. If you don't happen to meet the prevailing wage requirements, there is a cure. You can pay the difference between the actual wages that were paid by the contractors and the prevailing wage plus interest to the worker. So the worker still is going to get the same amount. And then you also have to pay a penalty of $5,000 per worker to the government. So I think a lot of people are very aware of this. I will tell you the contractors are aware of these requirements. But if you happen to miss, you're not totally sunk on the prevailing wage requirement. There is a post cure that you can go in, and given the difference in the credit rates, it might be worth it. The second requirement that is also necessary to go from the base rate to the bonus rate is an apprenticeship requirement. An apprenticeship requirement says that a certain percentage of the total labor hours must be performed by qualified apprentices. And so unless an exception applies, a contractor who employs 4 or more individuals must also use a certain percentage of qualified apprentices to perform the work. The applicable percentage is, you see, is 10% for projects that begin this year. It scales up, and you see it's 15% for projects that begin construction after January 1, 2024. If there is an out if a taxpayer makes a good faith effort to comply with the apprenticeship requirement. That is what a good faith effort is something that again we think we'll see Treasury weigh in on regulations. And then there's also an exception from projects to begin before 60 days after the Treasury publishes guidance. So we're in that period now. So if you have a project that's about to start construction, you may be excused from these requirements. So this is something you want to consult with your tax advisor about to get around to see if you're excused from these requirements if you otherwise aren't going to meet them. And with that, I'm going to skip the next slide and turn it over to Rob.
Thanks, Len. There's one question that can foreign companies get the benefits of the tax credits? Do you want to talk about that in the context of transferability?
Or why don't we wait to the end? I'll listen to the questions at the end.
Yeah. Okay. That sounds good. So I'm gonna just talk at a very high level about a few credits I'll start off with the renewable power credits. So generally, the Section 45 production tax credit and the Section 48 investment tax credit. I think a lot of the people on this call are probably already familiar with this credit, with these credits, and largely the same structure that applies to these credits. The structure did not change. So, and they're extended until 12/31/24. So the big differences with the PTC and the ITC is that, as Lynn mentioned, there's prevailing wage and apprenticeship, and then there's also additional kickers, which I'll talk about in a second. The Section 48 ITC is now it's extended for 3 new types of property. Ryan mentioned at the beginning energy storage technology. So before the IRA, you had to co-locate energy storage technology like batteries or hydrogen storage with the existing facility like a solar or wind. But now you can get a Section 48 tax credit just on standalone storage. There's also there is an open question about co-locating. So, if, for example, you have energy storage technology with a solar project, can you get the Section 45 PTC with the Section 48 energy storage technology? We've certainly got a lot of questions about that, and we think that Treasury will eventually address that with regulations. 2 other types of property: qualified biogas property. So that's very important to renewable natural gas producers, especially RNG producers at dairy farms. We've got a lot of questions about that credit, and then also microgrid controllers. I know we had a question about that in the chat. So you can get a standalone Section 48 ITC for microgrid controllers until 12/31/24. So after 2024, there's a new clean electricity ITC and a clean electricity PTC. So this is what Ryan was talking about. Currently the ITC and PTC is this enumerated list. There's you have to fit into one of the particular types of projects to get the credit. But after that, it opens it up to really a lot of different types of technologies, and certainly new and emerging technologies. It's very, very broad. The other big difference is that the PTC will be available not only if you sell the energy to a third party, but also if you use it internally. So that's a very big difference from the current PTC, which requires you to sell it to a third party. The other very important difference is that the PTC and the ITC will now only be available after 2025 if the greenhouse gas emissions is not greater than 0. So there's going to be a lot of timing issues as to whether you start construction in 2024 or 2025, and which credit you're going to take. And the other thing Ryan mentioned, the timing of the clean electricity credits, they go on for at least until at least 2032, but likely much longer. So there's a lot of lead time. I think previously there's these ITCs and PTCs were subject to extenders, and I think there was some hesitancy of going through with the project because you didn't know if the credits would be extended. But now you have a really wide, a really long lead time. So next slide. So what Lynn was talking about, the qualified, the apprenticeship, and the prevailing wage. And Ryan mentioned this too. So, generally all taxpayers get a base rate. So the ITC rate is now 6%, and the PTC rate is 3 cents per kilowatt an hour. And then you only get this bonus rate 5 times the base rate if you meet prevailing wage and apprenticeship. So the other big difference between the structure is that now you get additional kickers. So you get an additional 10% if you meet certain domestic content requirements. So that's 100% steel, 100% iron, and a certain percent of manufactured products in the U.S. You get 10% if you're in an energy community. That's generally a lot of communities that are impacted that have high levels of employment in the oil and gas sector. And you can get an additional 10 or 20% if the Treasury Department makes an allocation of environmental justice for certain smaller solar and wind projects. So, at a minimum, without Treasury Department approval, you can get a max of 50%, for example, with the ITC if you check all the boxes. And then, if you get an allocation from the Treasury Department, you can get up to 70%. So really, high numbers, and this really changes the economics of a lot of projects. The other thing I'll mention is that, whether or not to take the PTC and the ITC, that will be very project specific, and you're gonna, everybody's gonna need to model out, what credit gives the best answer. The other things, to think about, as Lynn mentioned, transferability. There's a little bit less transferability risk. There's no recapture for the PTCs, unlike the ITCs. So we might see more of a market for PTCs in the transferability market. The other thing is, whether or not you need an immediate cost or capital for the project, whether or not the ITC makes sense, or if you're okay with, that 10-year longer term credit from the project. Next slide. So the other another really important credit that we've certainly been looking at a lot is the hydrogen production tax credit. So this is a new 10-year hydrogen PTC available for the production of qualified clean hydrogen that results in a life cycle greenhouse gas emission rate of not greater than 4 kilograms of CO2e per kilogram of hydrogen. There's also the choice to take the ITC. If you take the ITC, you can treat it like a Section 48 ITC, subject to the kickers up to a max of 50% credit. The other really interesting thing about this credit is that it's not dependent on the feedstock that you use. It's really just how much hydrogen you can produce. So we've seen a lot of clients in very different industries that are looking at this hydrogen production tax credit that it's very wide ranging. So the credit, the PTC credit amount, it's you've got the base rate of 60 cents per kilogram or bonus rate of $3 per kilogram, both adjusted for inflation times an applicable amount. So pretty much if your hydrogen is less than 0.45 kilograms of CO2e per kilograms of hydrogen, you get $3 per kilogram if you meet prevailing wage and apprenticeship. The other important consideration, what Lynn mentioned, there's direct pay for this hydrogen production tax credit for 5 years. And then the other thing I'll mention is that there is, with these new credits, there's certain anti-double dipping provisions. So you can't get the 45V, this hydrogen production tax credit with the carbon capture credit and the new clean fuel production credit. So it's even more important to just really model out your what credit makes the most sense. Next slide. So the carbon capture credit, so this isn't a new credit, but I think before the IRA, we didn't see a lot of appetite for the credit. But with the IRA, the minimum capture thresholds are significantly lower and the credit amounts are significantly higher. So I think we've certainly had a lot of interest from clients that are thinking about taking the 45Q credit. It's a 12-year credit, and you get direct pay for the first 5 years. But again, there's this ANSI double dipping provision, and you can't get the 45Q with the hydrogen and with the clean fuel production credit. So you just have to look at which credit makes the most sense for your project. Next slide. So there are two, Ryan mentioned there were two manufacturing credits. Now, we'll go through these pretty quickly. This first one is this Advanced Energy Project credit. This is not a new credit, but the IRA gave the IRS an additional $12 billion of funding for this credit. So to be eligible, the taxpayer has to apply for the credit, and the IRS must award a tax credit to the taxpayer. So the application for this credit will be, I think, going live sometime early next year, and we expect this credit to go very quickly. Next slide. And the second manufacturing credit is this Advanced Manufacturing Production Credit, production of eligible components like solar, batteries, and wind, and the sale of that eligible component to an unrelated party. This credit is not structured like a lot of the other credits that I just went over. Instead, it's just a fixed rate based on the eligible component, meaning there's no prevailing wage and apprenticeship for this advanced manufacturing credit. So it's really just how many of the eligible components you can produce and sell in the U.S. It applies for the next 8 years before January 1st, 2030, and then there's a phase out for the next 3 years after that. And I guess the one thing that we've definitely got a lot of questions about is what production means, and just how much production do you have to do in the U.S. Is it final assembly? Is it something that is it what production has been referenced in other areas of the tax code, or is it something kind of more transformative than that? That's definitely an open question. We've certainly had a lot of clients who are thinking about moving more production to the U.S., but just how beneficial that will be kind of depends on this credit. Depends on what production means. Next slide. So there are a few, just wanted to touch on a few of the electric vehicle credits. So Ryan mentioned there's a new qualified commercial clean vehicles credit. The one thing I really wanted to highlight for this group is that unlike the car credit that for non-commercial vehicles, which requires final assembly in North America, this credit does not require final assembly in North America and does not have any critical minerals or battery components requirement. It's also not subject to income limits or MSRP caps. So this is really just this credit is structured very differently from the credit that's being reported in the press, and that a lot of our trading partners are very upset with the Treasury about. So you get up to $7,500 a vehicle for vehicles of less than 14,000 pounds, or a max of $40,000 credit for other vehicles. Next slide. And then I don't think I'll cover the fuel credits, but just very briefly, there's a new, well, this isn't a new credit, but it's an extension of the EV charging stations credit. So you get a max, this is similar to the other credits, you get a base rate, bonus rate, 6% and 30%, up to a limit of $100,000 per station. The one thing about this credit is that it's only EV charging stations in low income communities and a census tract that is not an urban area. So really, what that means, I think we'll definitely need regulations on that. But it is a credit, it is a credit that a lot of EV and battery companies should be aware of. So I think we could probably stop for Q&A.
Okay. Awesome. Thank you, Robert and Lynn, for teaching us about these new concepts like credit transferability and walking us through the next tax credits and how to take advantage of those. I know you guys work with these concepts every day, so we do appreciate being able to see all of this through your perspectives. We do have quite a few questions, which I would like to get to here. So I guess the first one, and this goes for either of you. Actually, this one is directed specifically to Lynn. Could you just clarify the meaning of taxable year facility placed in service?
Yeah. So placed in service is a concept that's used. It's the date when you start depreciation on property. It's also used to determine when the credit is earned. For energy property, I would say probably the starting rule of thumb would be the COD date. So that's generally the date that you can actually produce energy and sell it on the market. That typically is going to be the placed in service date. And so the year in which you have received your COD, that would be the year in which it would be placed in service.
Wonderful, thank you. Another important question, are foreign companies allowed to apply for the IRA energy funds? And if so, can they get tax credits or benefits similar to the American companies?
Yeah, I'll start, and Rob, if you have anything to add on this. I mean, generally, remember these projects need to be in the U.S. And if you're a foreign company looking to come into the U.S. market, more than likely you're going to form a U.S. subsidiary for tax reasons that have nothing to do with these credits, because you're not going to want the foreign company directly to be filing U.S. tax returns, for example. So you probably would be forming a U.S. subsidiary to conduct your U.S. operations. That U.S. subsidiary would be eligible, if it met the other requirements for the credits, to claim those credits and sell them. So that's my take. Rob, what do you have anything to add?
Yep. Yeah, that's what I think.
Yep.
Awesome. And then one more question. Would responsibility revert back to the original credit holder should a transferee go out of business?
That's a good question. So I think this relates again to transferability. So I built my energy product, placed it in service, and sold my credits. And then there's a recapture event right later. And the transferee has bought the credits, paid me the cash, and something's happened. And again, we're not sure, again, whether direct responsibility should be on the transferee or the transferor in that matter. If it is on the transferee, I would expect that Treasury would say that the Treasury might adopt a rule. That might be adopt a rule that there's a secondary liability, but again, we don't know until we get those answers back from Treasury.
And just one other quick point. I know there was a comment about how complex the IRA is, and I think that's absolutely true. Lynn and I have spent many hours since August looking at these provisions. And we understand not everybody wants to be a tax lawyer, but I will say, to something Ryan mentioned, the IRS is requesting comments, and to the extent that you think that these provisions need clarification, or there's a good way to kind of monitor or implement these policies, I think they definitely want feedback from the energy community.
Right. Okay. Thank you guys for all your questions. Again, feel free to ask them at the end. We do want to move on to the next speaker, though. So I'd now like to introduce Mr. John Loving, Senior Government Relations Advisor at Kilpatrick Townsend and Stockton, as he updates us on the status of implementation and what we can expect out of Washington moving forward.
Hey, Larissa, good afternoon. Good afternoon, everyone. Just want to make sure everything's working on my end.
We can hear you.
Okay, great. Thank you. So, hi, everyone. I know we've gotten a lot of detail on this, and I'm the last speaker, so I'll try to keep my comments brief so we can get to the questions. So, just a quick introduction on me. My name is John Loving. I'm a registered federal lobbyist, have been one for over 20 years. I work with a lot of renewable clean energy companies. I spent a good part of a year on the Build Back Better Act and the Inflation Reduction Act, working with companies in the energy storage industry, fuel production industry, hydrogen energy, carbon capture, you name it. We were engaged with Congress on the IRA on this and worked with them to kind of put together a bill that's really going to help supercharge the industry and really, quite frankly, as we've all been saying and we all know, is a huge game changer in the industry. So I'm going to talk a little bit on the political side. The bill was purposely built, I think this was referenced before, to give the administration a lot of discretion in implementing it. So it was a huge victory building the bill and then passing it. But as Yogi Berra used to say, it ain't over till it's over. We still have a lot of things to do and a lot of places to fill in and get done before the bill really starts doing its job, giving tax credits and distributing money through grant programs. Next slide, please. So we talked about this earlier, right? The implementation of the IRA has begun. Very quickly after the bill came out, the electric vehicle tax credit initial guidance was released. That was a big deal coming out that quickly. But what came out recently was that first round with 6 items, right? And these are all 6 very important items, the energy generation incentives, and I put links on my slides. So you have them, the prevailing wage, apprenticeship, domestic content, energy community requirements, incentives for homes and buildings. Next slide. The consumer vehicle credits, manufacturing credits, direct pay and transferability issues. So why does the IRS put out these requests for comments? Because part of their job is to figure out how to implement this in a way that is going to be fair and really get things rolling on the IRA. We still have some time. The one thing I want to emphasize here is we have a lot of time to shape things. The IRS, quite frankly, the limited engagement I've had with them over the years is they need all the help they can get on this. They need to understand how your company works if you're going to take advantage of the consumer vehicle credits. They need to understand what the best way to implement it and get those tax credits to you to help your company. So they need to hear from you, and I'll talk about that a little bit later. But I can tell you this is just round 1. There's more coming. The IRS, we're hearing, will have something out the 4th quarter. I don't know if DOE will. You know, a lot of what we're hearing is just kind of side conversations, but I know the administration is spending a lot of time and energy trying to get to implement this thing. Next slide, please. So, as the IRA is implemented, I'm going to talk a little bit about the issues of interest to Congress. So, Congress is very engaged on the implementation because they gave a lot of discretion and they have a lot of viewpoints on it. I can tell you, especially the House of Representatives members are very engaged. They were uh, only a limited number of House members were actually working on the bill while it was being drafted in the Senate. It was very Senate heavy. So there's a lot of House folks who are interested in getting this implemented the right way. Direct pay and transferability structure. That's huge. How are we going to get this direct pay to companies? When? Is it annual? Is it by project? What's going to be the best way to do this for the industry, but also to prevent fraud? Those are issues Congress is engaged with the IRS on. The energy community tax credit eligibility is another. There is a lot of discretion in how you define low income areas, energy or energy communities, and you know there are certainly different types of definitions out there in the federal government, and they're trying to get their hands around it. A lot of members want to shape it the best way they can for their states. Domestic content standards, I can tell you, I think there's going to be a lot of arguing over this, and I know our previous speakers got into this, but you know, you run into issues obviously when you talk about a part that's only manufactured in China or Italy. Are you going to punish people? How much are you going to punish them for using that part? How much of something needs to be manufactured in America to get that domestic capacity and domestic content tax credit? So there are a lot of companies that will comment on this and a lot of members of Congress commenting on it. Lastly, the fuel credits is a big one. Sustainable aviation fuel, how it's done, how that credit's implemented, what it looks like down the road in the years to come. You know, how much of a credit you will get is a big debate with members of Congress as well. They are engaged on that as well. Next slide. Technical corrections legislation. So what happens in modern Congress when you have a huge tax bill like this is there will, at some point after the bill, as the administration's implementing it, there are problems with it. There are things that need to get fixed or tweaked. So Congress will often introduce a technical corrections package or set of provisions. What these do is they make sure the administration implements everything with the congressional intent of the bill. So in 2017, with the Tax Cut and Jobs Act technical corrections bill, there was one introduced shortly after the bill was passed. A number of those provisions were passed 2 or 3 separate ways as part of bigger bills. We're going to get it for the IRA as well. It's inevitable. I can tell you the Finance Committee, House and Ways Committee, House Ways and Means Committee, they're talking about it already. What do we need to do to make the bill better, to tweak things the right way, and to make sure it's being implemented the way we want? This is we talk about the implementation, the request for comments. This is another way. If the bill is not working the way it needs to, Congress can and will pass technical corrections for it. So that's something, as a lobbyist, I'm keeping an eye on for my clients and looking for ways to tweak the bill that are going to better implement what the bill was intended to do. Next slide, please. So a little bit on next steps. Like as I said in the beginning, there is much more to come. This is round 1 of requests for comments. I believe we talked about requests for information. DOE does a lot of those. They do a real good job on those. So expect to see a lot of those coming out. Rulemaking regulations will begin shortly on some parts of it. Also in the RFIs, DOE is not the only one. Department of Interior has grant programs that are under the IRA that will need to have RFIs and rulemaking. And then there will be applications for them. So we still have a lot to go. Everything has not been decided on the implementation front. And that's why my next step says engage. The request for comment period is the best way for companies to let the IRS, Department of Energy, and other departments know what the best way to implement this bill, the tax credits, the programs. How can you implement it in a smart, efficient, fair way that is going to benefit the industry? I can tell you, I'm anticipating thousands of comments on just the 6 notices that were dropped recently. There will be a lot. It's important for companies to engage, to give comments. You don't want to leave that up to chance. You don't want to leave that up to someone else who has different priorities than you. Let them know how this can work. Also, with Congress, same thing. Congress is talking to companies and stakeholders in their states and districts. They are talking not just about companies that are there, but they are very interested in, okay, I'm a company, maybe a German company, maybe a Canadian company. I have been looking to build something in Pennsylvania for 2 years. With these incentives, we can do it, but there are some issues. Like members of Congress are meeting with companies who are planning projects in their district and can now have a much more robust conversation about their business planning for that and how to take advantage of those incentives. I've had a number of meetings with folks and projects that are still a year or two out, but we're going to try to move forward on, and they want to help those companies with the implementation as much as possible. And yes, they are talking to the IRS, and yes, they are talking to Treasury, Department of Treasury. Yes, they're talking Department of Energy. And they are pushing what they feel will help, potential projects, companies that are already in the state, move forward with these. So one thing I'd say moving forward is my message is 2 things. 1, we're not done yet. There's a lot to do. There's a lot to implement. There's a lot of information that needs to be collected. There's a lot of information to be released. 2, engage. These requests for comment are there for you to have your voice be heard, and engage with local members of Congress because they want these projects in their district. Let me repeat that. They want these projects in their districts. It's renewable energy. It looks politically good. It's jobs. Texas, because of its business tax structure, is becoming a hub of renewable and clean energy companies. The senators from Texas are now becoming renewable and clean energy experts, and they're very conservative Republicans. So I'm telling you, folks want to know about this. They want to talk to you, and they want to know how to make this act work for you. That would be the second part of my message. I'll wrap it up there, and I know we have questions. So thank you.
Great. Excellent, John. Thanks for synthesizing all of that information and really laying the importance on staying engaged, right? This week, the squeaky wheel gets the grease. So it's very important to voice your concerns, how you want to see things done for your company so that you can capitalize on these tax credits, make it work the best it can for you. So now we'll open it up to any remaining questions from the audience. Again, please type them in the chat. It looks like we do already have some for you, John. What do you think is needed for smaller and medium-sized companies to do now? Perhaps when they do not have enough resources. Should they hire for implementation? Sorry, I don't quite see request for comments. I guess, okay, so what is needed now for smaller and medium-sized companies?
Sure. So for large corporations, they have a staff of attorneys and MBAs who write comments, and they'll have polished comments. That's great. But there will be small companies writing 1 or 2 pages of comments. If you have a very good understanding of this, I would say try to draft it, work with somebody who can help you sort of synthesize it in a way that'll be helpful to the government and get it in. I think you should not wait on the comments. If you know that a way to implement a tax credit, if you know the way that's going to help your company, you're going to know it better than DOE or the IRS. Go ahead and get that done.
Great, thank you. Looks like we do have another question from Britta here. What does a German supplier have to do to prove, let's see, for products that do not exist or there's enough of more? I apologize. Britta, do you want to type in the chat and expound on that question a little bit more? We're going to go to this question from Greenie. Can an EV charging station be qualified for Section 30C credit? Robert, I think that was pertaining to your presentation, possibly Lynn's.
Yeah, the 30C, I think the big thing with that is it only applies to certain areas. So we'll need guidance as to what areas that qualifies for. But there's that, and there's also the energy storage technology, the ITC, and that's not geographically limited.
Okay, great. And I'm going back to a question that is from Ryan's presentation. Could you speak to any benefits specifically related to the development of microgrids?
Yeah, I think one of the other presenters also noted that the investment tax credit has been extended to include microgrid controllers at a minimum. And of course, many of the constituent parts of a microgrid may also receive a tax credit. So if solar is part of your microgrid, it can receive the investment tax credit, or a production tax credit for that matter, conceivably. So in addition to the microgrid controllers, many of the constituent generation pieces would be eligible, and of course storage as well. And again, importantly, storage need not be directly paired with solar to now access the investment tax credit. It can be a standalone storage device or a storage device that is part of a microgrid. So the important part here is that there are a variety of pieces of the microgrid that would be eligible for tax credits. A diesel genset as part of a microgrid would not be eligible for any of these tax credits, but the clean energy components as well as the controller would be.
Great, thank you. And another question coming for Lynn and Robert. What is phase out for facilities financed with tax exempt bonds?
I can reply to that. So basically there have always been rules that say if you are financing a facility that's subject to credit with tax favored debt investment, meaning you're getting state and local bonds to help finance your facilities, and the holders of those bonds have to report interest. Congress has always said that it's that is kind of a double benefit that we want to we don't want to allow that kind of double benefit. So what they do on the credit side is, to the extent the construction of your energy facility is financed with these kind of tax exempt bonds, there's not a phase out. There's actually a reduction in the amount of the credit that you get. It's equal to the percentage of your cost of constructing the facility that were financed by those bonds. So you take the proceeds from the bonds, you divide that by the total cost of the facility, and that gives you a percentage that reduces the amount of your credit, and that applies both to the Section 45 PTC as well as to the ITC. That caps out at 15%. So you even if you finance 20% of your project with tax exempt bonds, you're capped out. Your reduction is only 15%.
Mm-hmm. Okay, great. And this is also for you, Lynn. Mark is wondering if you could discuss a transfer discount market from a federal versus a state perspective.
Yeah, I think I did actually cover that in my presentation. but basically, what our experience with the state market is there's about a 10 to 15% discount off the credit in terms of what the buyer actually pays. And we would expect that, if anything, this market to be in effect probably more efficient, because what we've seen at the state level is it's much more of an individual retail market, which probably gathers higher discounts. We would hope that the federal credit would be a little bit more efficient, and therefore the discount would be less.
Thank you. Okay, and then Britta is wondering if there are any exceptions from the domestic requirements, i.e. when something is not produced in the US. What do these exemptions look like? What are the implementations for that? And how does this affect German suppliers or German firms?
Yeah, that's a really good question that we don't know the answer to yet. One of the things we didn't get a chance to cover in as much detail as we'd hoped is, in addition to the base and bonus rates of credits, there are what we refer to as kickers to the rates. So, for example, for the ITC, you can actually go from 30% to 40% to 50% if you meet additional requirements. One of those requirements that we give you an additional 10%, assuming you met wage and apprenticeship requirements, is something called domestic content. So you have to show that that all of your steel, iron is manufactured in the U.S., as well as other manufactured products are manufactured in the U.S. With respect to other manufactured products, to find out that it's manufactured in the U.S., you sort of have there's a sliding scale. But even if you can't find those manufactured products in the U.S., there's not a producer in the U.S., right? There is an out that says you don't have to meet those domestic content requirements with respect to those products. This will be something that will be not necessarily the supplier will be saying there's no market in the U.S. for this. It's actually your customer would be. How you would go about certifying that is something we think would be high on the, because there's no real detail right now as to how to do that. So we think that will be something that Treasury will address in regulations.
Okay, great. And final question here. Are credits a discount from basis?
Yes, to the extent you're allowed a credit, you do have to reduce your basis by a portion of the credit. So you get a little bit less depreciation. But given that a credit reduces your tax liability dollar for dollar, and depreciation only is the deduction that is the value of which is depends on your a percentage of that deduction. It's still always better to take a credit and get less depreciation.
Awesome. Thank you so much. So it's looking like about time to wrap things up. Thank you very much again to our speakers and our experts for being here. We absolutely appreciate you sharing your insights and your knowledge with us. And to all of our audience members, we're so glad that you could join us today, and hope that you're able to take away many of the fascinating points that our speakers brought up. Of course, if you have any questions, feel free to use the contact information that was on the previous slide and reach out to anyone. With that, I hope you have a great rest of your day. Goodbye, everyone.